Have you ever wondered how international funds can impact the Indian equity market? Well, sit tight as we dive into the fascinating world of finance. First, let's understand what international funds are. These are essentially mutual funds that invest in companies located outside the investor's country. Now, how do they influence the Indian equity market? You ask? Well, the amount of money these funds invest in Indian companies affects the demand for these companies' shares, which in turn influences their share prices. Now, let's turn our attention to a recent decision that's been making waves in the financial world. The U.S. federal government pension fund, which is a significant player in the global finance arena, has decided to switch its benchmark index for international funds. This switch is expected to cause an inflow of $3.6 billion into the Indian equity market. To put that in perspective, it's like injecting a hefty dose of financial adrenaline into the market, which could potentially turbocharge the performance of many Indian companies. This decision is indeed a significant one and could have far-reaching implications. Let's delve deeper into the U.S. federal government pension fund's decision to switch its benchmark index. The Federal Retirement Thrift Investment Board, or FAR-TIB, currently manages assets worth a whopping $600 billion, and until now, it has been using the MSCI EAFE index as a guide for its investments. However, a significant shift is on the horizon. The FRTIB has decided to move its benchmark from the MSCI EAFE index to the MSCI ACY IMI X USA X China X Hong index. This seemingly complex title essentially represents a broader, more diversified index, excluding the United States, China, and Hong Kong, but including a wider range of other global markets. So what prompted this change? The reasons are twofold. First, it reflects a desire for greater diversification, as investing in a broader range of markets can help to reduce risk. Second, it's part of a broader trend towards considering emerging markets like India as viable and attractive investment destinations. The implications of this decision are far-reaching. It is expected to reshuffle a staggering $28 billion in equity investments around the world. Emerging economies stand to benefit significantly from this change, and India is no exception. The Indian equity market is projected to see an inflow of approximately $3.6 billion as a result of this switch. This influx of investment could provide a substantial boost to the Indian economy and its financial markets. Local banks, such as the State Bank of India and ICICI Bank, along with market indices like Nifty and Sensex, are likely to see positive impacts. Such a shift in investment strategy by a significant player like the U.S. federal government pension fund can indeed set new trends in the world of international equity investments. To wrap up, let's revisit the key points discussed in this video. We've delved into the impact of international funds on the Indian equity market and the significance of the decision made by the U.S. federal government pension fund. This decision is not just a game changer for India, but also for global economies. The U.S. federal government pension fund's benchmark index switch is projected to bring a substantial inflow of $3.6 billion into the Indian equity market. On a larger scale, we're expecting a reshuffling of $28 billion in equity investments around the globe. This move is not only a testament to the growing strength and potential of the Indian equity market, but also an indication of the increasing interconnectedness of global financial markets. The Federal Retirement Thrift Investment Board's decision to shift from the MSCI EAFE index to the MSCI ACWI IMI X USA X China X Hong index has set the stage for a new era of investment opportunities and challenges. It will be interesting to see how this decision plays out and what it means for the future of the Indian equity market. Stay tuned for more updates and insights.